and welcome everybody. My name is Len Lonzi. I'm the Managing Director for the Preccelerator program here in lovely Santa Monica, California. We are a program of a law firm, and we are the only accelerator program that we know of that is actually sponsored by a law firm. It's Stubbs, Alderton, Marklees. We're a full-service transactional and litigation law firm located in Sherman Oaks, California. And today we have a workshop that is being conducted by one of our mentors extraordinaire, a good friend of mine, and one of the best minds I can find on financial modeling and making the financial side of your businesses look presentable and give you the information you need to manage your business. So Mark Wald, with that, I'm going to let you do a self-introduction and go from there.
Thanks, Len. I appreciate it. So I am Mark Wald again. My business is here supporting Strategies Los Angeles. We're an outsourced accounting and finance department for growing businesses, startups, small businesses, and some nonprofits, in fact. And I have to thank a few of you on this call for trusting me and my team to refer some clients our way. So thank you very much. At least 3 or 4 folks on the call here today are already active partners.
Mark, just before you start, one quick housekeeping item. Folks, if you mute yourselves, that would be great. And then ask questions in chat, and I'll manage the questions. And then finally, I suggest going to speaker view, and that gives you a good idea of Mark's presentation. And then when he shares his screen, you'll be able to see that also.
Yeah, I'll throw a slide deck up here, and we'll talk through that in a few minutes. So just by way of background, I've been in business 6.5 years with this accounting services company. I'm also a tech company co-founder. I built a business called Ballpark, B-A-L-L-P-A-R-Q. I guess more accurately, my co-founder Carrie built the business with the tech team I advised on the financial side. Ballpark is an online financial modeling software for growing businesses. Hi, Lonnie. So it's free to use. There's a premium service you can upgrade to, ballparq.io. That was born out of the Stubbs, Alderton, and Marklees Preccelerator a few years ago. I'm also a Tech Coast angel investor in Los Angeles. I have an e-commerce startup that I'm co-founder of as well. And my firm has partnerships with venture capital businesses that invest in life sciences, biotech, technology, e-commerce, SaaS businesses, and we work with all kinds of companies. So I'm coming to you with a lot of experience building financial models. Excel is my playground. I like playing with numbers in Excel. We'll get into some live demos in a financial model. A few of you on the call have seen that before. I'll be happy to answer questions and just kind of go off the script and take this conversation wherever you guys want to. So I have 2 presentation decks available to zip through today, and I'll go quickly so that we save time for Q&A and to answer your specific questions. Slow me down if you need me to go more slowly, but I don't want to bore anybody. So the first deck we're going to go through is financial modeling and capital raising for startups. The next one would be KPIs. What are they and how to use them? And it'll be relevant for businesses that are already in action and also for startups that are kind of visioning out their growth path in the future, so you can be thoughtful about what key performance indicators would be relevant for you to keep track of and for investors to get excited about what you're working on. All right, so let me start my screen share right here. And hopefully you can all see what I've got up on the screen now, yeah?
Yep.
Okay. So, I like to think of financial models as a piece of software that lets you test, validate, and share your business model assumptions and communicate that with others in a logical format that they can understand. If you oversimplify your financial model, you miss the opportunity to validate those assumptions. If your model is too complex, it won't concisely communicate your vision. So finding the right balance in between will cleverly demonstrate your level of sophistication to investors. Let's be honest, investors are both greedy and risk averse. And I'm actually borrowing this, some of this presentation deck and some of the verbiage in here from one of my mentors, Ellie Eisenberg, who's a Preccelerator advisor as well, a mentor, great CFO, got 40 years of experience in finance and accounting, and lots of experience raising capital on behalf of his client companies with investors. So investors are both greedy and risk averse. The goal of your investor pitch then is to demonstrate credibility, build confidence that the investors have in you, and show them how you can make money. Your financial model has to address all of these things so that it's a tool to build that confidence and to demonstrate credibility that you've done your homework and the investors can trust you to make the money you're projecting. Okay, so some rules for the financial forecast. Obviously, credibility. You need to consider internal and external constraints. So let's do something here for a sec. Where's my Zoom link? Meeting controls. Okay. Who can tell us like an example of an external constraint for your business, or an internal constraint for that matter? What are constraints? We've talked about this. How about Kyle and Ossie, excuse me. Your business, Pickle, you're working with brands and stores, right? So an external constraint for your business might be how many brands are there in the marketplace, in the world, that could possibly engage with you as a customer. If your financial forecast model is projecting that you're going to have 2 customers today, and then we're going to grow it by 10%, tomorrow you have 2.2, the next day you'll have 2.4, and we'll keep growing by a factor of 10% each period. Pretty soon your model is going to forecast that you're going to have 25 billion customers when you get out like 3 or 4 years into the future, and that's not realistic. So you need to think about that external constraint and make sure that you validate your assumptions that you're going to be aligning with those external constraints. How about an internal constraint? Not all at once here, but I want to have some engagement just to make sure you guys are understanding what we're talking about.
Does internal versus external constraints have anything to do with external market activities, like market forces that might be impacting it? So for us, if it's brands or weather patterns for shoppers, or internal constraints that might have to do with bandwidth of the team to reach out to the 40,000 brands, is that kind of what you're referring to?
Very good, yeah. So the bandwidth of the team, like time and availability to perform activities, could be an internal constraint. If you're manufacturing things, it could be the throughput of your equipment. How many units can your equipment produce in a given hour or day? If you have a factory or a warehouse space, how much product can be contained within that physical space? And you need to consider those constraints as well so that you're not missing the mark on how the business scales over time. Okay.
Mark, someone offered external constraint as being the pandemic.
Sure. Well, the pandemic probably imposes changes to what would be your normal constraints. And so those are temporary constraints that could be very relevant depending on your business model. One of my clients provides a COVID-19 testing service where they send nurses and other trained medical staff into nursing homes and large like workplaces to test hundreds of people at the same time as a service to provide safety for the people in those spaces. And so COVID-19 has a lot of relevancy to their business. Okay. Supportable. What does that mean? That means do your homework. You should, it's easy, it's common for entrepreneurs to say, okay, I want my business to make $500,000 income next year, and then $1 million the next year after that, and then $3 million, and then we get this hockey stick and we go up to $12 million. Those are great targets to have, but how are you going to actually achieve those results? You need to build the financial forecast model from the bottoms up, not from the tops down. Think about all the individual activities that are going to take place that will yield those results that you're shooting for, and do your homework. Research online, find market comparable data points about other businesses that have publicly available data, so you can say, I believe my user acquisition cost is going to be X because here's all the homework I've done that informs that decision. Okay, consistent. Your business plan and your financial model should be in sync so that one tells the story of the other, and you should also follow convention. It's hard to do if you use a generic template to have your financial forecast model align with what your actual business model is. So we'll get back more to that when we go through some examples in a few minutes. So cash flow is a very often overlooked consideration in many financial models. Let's see, there's one of you on the call that has a marketplace platform for hospitality bookings, right? For booking vacation homes. So in that model, the customer might pay upfront a partial deposit and then later pay more money for the full booking or some time frame in between. And then the person who's renting the space doesn't get the money until the booking is completed later. And there's the different timing of when the revenue is recognized and the cash flows through the business and flows out of the business. So really think through that for your business and make sure that you're not overlooking meaningful time shifts between when you recognize revenues and expenses and when the cash actually comes in and out of the business. Churn rate is an often oversimplified metric used in user-based business models, yet it's one of the most important metrics in a subscription-based business. So building out the right level of detail in your churn assumptions gives you a lot more insight and control over your performance and outcomes. So I'll show you an example of that later. But what's here on the slide, this is actual real data from a real marketplace business. This is kind of like an Uber for fill in the blank business. It's an on-demand gig economy platform. And what we're seeing on the screen are what's called cohort analysis. So if you see on the left-hand side, 2016 period 8 is August 2016. So the first row of percentages represents users who first started using the platform in August 2016. The next row is people who started using it in September and October, so on, all the way down to May of 2017. And we see how many people are in each cohort group. So the first group was 43 users. And then going across to the right, we see what percentage of those users are engaged with the platform and are retained, still active users after each period in time into the future. And one thing that's easy to notice here is all those percentages are different. They're different relative to the start date of each user when they first started using the platform, and they're different over time as well. So your financial forecast model should consider those different things. Like if you have a peer-to-peer messaging app, like WhatsApp is your business. Well, when a new user joins WhatsApp, by nature, they're probably going to invite 5 or 10 or 20 of their friends to join the platform, and you're going to have a high number of new users referred, and you're going to have a high level of engagement up front. But then some users are going to really like the messaging platform, other users are not. And so a lot of people are going to make up their mind within the first month or two, and you'll have a high churn rate because a lot of people will stop using it right away. And then the more people use it, the more it becomes part of their daily routine, and then their churn rate is probably going to get lower further out into the future relative to when they started using the app. But if you started a user like in January of this year and they've stuck with it all the way through to November, they're likely going to continue using the app over and over again, so their churn rate's going to be much lower than people who just signed up at the beginning of November. So you can't really accurately apply the same percentage churn rate just month over month to your entire user base. That's not going to yield a good result. So I'll show you some Excel-based templates I have that model this out in a little more detail later. Ultimately, you need to know your business model. Who are your customers? How are you going to reach them? How much will they pay? What activities and resources will you rely on to succeed? What are the relationship dependencies between the systems and workflows and partnerships and people and activities? And how do those assumptions change over time? So your financial model should consider all those interactive relationships happening between those different components of your business. Aside from the financial model itself, the process of creating a bottoms-up financial model and then testing different assumptions is often the most valuable result of the whole exercise. Yeah, the financial model as a work product and a forecast is fantastic, but going through the exercise, and it's painstaking, it takes hours and hours and hours. It's the exercise itself that's often more valuable than the forecast that you get as a result, because it forces you to ask yourself those questions, poke holes in the different scenarios that you're envisioning, and discover hidden costs or benefits or risks. Okay, so how do we build the model? Logically organize information, okay? Keep things neat and easy for someone else to understand who's not inside your head. Clearly display your assumptions. There's a few different schools of thought with financial forecast modeling. Some people like to put all the assumptions on one tab in an Excel file or a Google sheet, and then have formulas and data in another set of tabs. I like to put my assumptions together with the algebra that's showing the end result. 2 times 3 equals 6. If I hide that 2 on another sheet, then someone else who's not me has to keep flipping back and forth between different tabs in order to understand what's what, and that gets boring pretty quickly. So if your goal is to have other people be able to understand and gain insights from your model, don't give them extra homework to jump back and forth between sheets. That's my opinion. Forecast your numbers by month, not by quarter, not by year. You can certainly roll those assumptions up in a summary level, quarter and year view, but the assumptions themselves, the forecast needs to be on a monthly basis. A lot can happen from month to month, and you're creating a lot of busy work and a big margin of error if you're forecasting on a quarterly or annual basis. So don't do that. It's just a waste of your time. The time horizon for your model really depends on what stage your business is in. An early stage company might only need a forecast for 18 months out. If you have a little bit more traction, or your business model itself needs more time to get up to cruising altitude, then maybe 3 to 5 years would be appropriate. Even if you're only raising money that's supposed to last you 12 months or 18 months, likely your business isn't going to have a successful exit 18 months from now. So what's going to happen after you spend that last dollar? You're probably going to need to raise more money and go after a bigger opportunity, expand your market size, or introduce new product offerings or something. So if you don't have that story and vision out into the future, investors aren't going to know what they're investing in, and you won't know, how to communicate that to them.
Hey, Mark?
Yeah.
Did you jump in with questions?
Go for it.
I wasn't sure because you said you wanted to interactive. Along with all of this, how do you feel about kind of just the general use of funds that investors ask about, right? So you have your projections, your forecasting models, your assumptions are all laid out, but now sometimes they want to just know general use of funds. What are you going to do with my $1 million, and how is that going to equal $1 of revenue versus $1 of growth for them? Is that
good question? We'll get there. We'll get there in a couple of minutes. A few more slides. So summarize your KPIs with context. I'll give you some examples of that. And review and test your work should go without saying. Like, you don't want to send a forecast model that has formula errors to an outsider, because that raises questions about your credibility and your attention to detail and your ability to succeed managing the investor's money and running the business to a successful outcome you're hoping for. Okay, when you're presenting the financials in the pitch deck, summarize your financials in one slide. Okay, don't obscure the facts, don't misrepresent numbers, don't show cumulative numbers when you go from year 1 to year 2. Don't show year 2 as the sum of year 1 and year 2, because investors don't want to feel like you're pulling a fast one on them, right? Remember, your goal is to demonstrate credibility and build their confidence in you. So if they feel like you're trying to trick them in your pitch, they're never going to want to invest with you. Okay, don't lose your audience in the details. This is a terrible slide to present, whether it's in a deck you're sending someone over email or something you're presenting live. No one wants to get lost in a sea of numbers like this. They can't tell where to focus. A chart adds a lot of clarity. It's visually intuitive. Okay. We can add some additional KPI data here for context. You see I popped up $750,000 seed round here, and then $2 million Series A round in the next year. That helps answer the question of how much money are you raising now and how much will you need to raise in the future in order to ultimately achieve the successful outcome. The KPIs down at the bottom of that chart show, well, how are we going to achieve those revenue targets? So you can see in year 2, it's at least 10,000 monthly active users in a user-based business would yield the revenue that we're forecasting here in the chart, and then growing by 10x to get year 3's results, and growing by 5x again to get year 4 results. So that provides context that helps with understanding how are you going to achieve that without investors having to, dig through a bunch of other records to get those answers. In an executive summary, you might have something that's more like a table format because it's more compact. Something like that could be appropriate. Still, in this case, there's KPIs up on the top that explain how we arrive at the results down below. Keep it simple, high level, not too many numbers. And I have a pet peeve with pennies. Don't include pennies. Nobody cares about pennies. You can round things to the nearest 1,000 or million if that's appropriate. You can see up at the top of the chart, I show that the numbers are rounded to the nearest 1,000, so people don't have to do math in their head. They can see very clearly that we're talking about 5 million, 10 million, 15 million, and 20 million on the left-hand margin. Okay. Aussie, we're almost to the use of funds answer for you. When you're asking an investor for investment in your company, you need to answer these 4 questions. And if you're not prepared to answer all 4 of those questions, whether it's in writing in your pitch deck or verbally during the Q&A, you're not ready to raise money from an investor, because investors need to know how much money you want to raise and what you're going to spend it on, what you're going to achieve with that spend, what valuation you're offering for their ownership in your company, and how much money you're going to expect to need in the future to continue operating the business and ultimately achieve the outcome that you're projecting. Okay, so here's an example solicitation. This is everything on one slide. You might not necessarily put all of this information on one slide. You might split it into 2. There may be too many words on the screen here. If this was a presentation you're doing live in front of an audience, you can trim it down with...
Give Paco some food.
You could trim it down and you could speak to the details verbally, orally, while there's less words on the page. But here you see we talk about how much money we're raising, the price, the valuation up at the top. The use of proceeds describes what that money is being spent on. And oftentimes people have a pie chart or a listing with actual dollar amounts that are summarizing of the $200,000, how much is going to go towards salaries, how much is going to go towards other activities. With regard to use of proceeds, I'd say keep it short and sweet. Maybe somewhere between 3 and 6 categories is the most you need to display here. If someone's interested in pursuing an investment with you, you'll have plenty of time to disclose more detail to them in a separate round. So keep it short, easy to understand. Here we have under marketing acquisition, it talks about the key milestones that the business is intending to achieve with the use of proceeds. And then it clearly shows that we're planning to raise another $1 million in a subsequent time period.
Hey, Mark,
Yeah.
Is it appropriate in use of proceeds, if you say you're raising $1 million and, 3/4 of that's going towards salaries, that's a huge red flag for investors. Is it better to break it out by functionality of what that money is going to be used for functionally, as opposed to just, salaries?
That's a great question. It really depends on the stage of the business, because it depends on the milestones you're trying to hit with that spend. If your business is engineering heavy and you're going to be heads down building software for 2.5 years before you release the product to market and start attracting users and generating revenue, then most of your money is going to go towards salaries, and that's fine. Then you probably want to break it down into different functional areas so they understand that you're allocating the right amount of spend to engineering versus sales and marketing and leadership and so on. And obviously you'll have a detailed staffing model in your financial forecast that breaks things down by individual resource. How much is each person going to earn, so that investors can understand that that's an appropriate compensation rate for those functions, and that you'll be, there's a high likelihood that you'll succeed with that staffing model. But for other businesses, no, like the salary spend might not be as relevant as something else. Like if it's a user-based app or platform, maybe your biggest spend is on marketing, user acquisition marketing. If it's an e-commerce company, it might be targeted digital advertising to drive traffic to the e-commerce website. There's a variety of other things that might be more expensive than the team, depending on the business.
Sure. There's another question here in chat. How do you factor valuation when you're pre-revenue and you're going in with a seed or friends and family round?
That's the $1 million question, or sometimes the $5 million question.
Yeah.
Well, remember, investors are in business to make money, right? So they need to understand what expected return should they be expecting for investing in your business. So if it's clear that you're going to need to raise another 1 round or 2 or 3 rounds of funding before you eventually have a successful exit, and your business could realistically sell to a strategic acquire a competitor or go public or whatever else you're going to do as a successful exit, then you kind of work backwards from there. And investors will say, well, if I'm going to invest $1 million today and it's going to take 5 to 10 years before you're going to achieve a successful exit, and I want to get X return for my money, then based off of like how much additional dilution I'm expecting to have over the subsequent rounds, I need to get this percentage of your company today. And it could be 10%, it could be 30%. So you really work backwards from what do you think your potential exit value is, how diluted will those investors get between now and then, and what's a good return for the investor. So we can do some math on that later. All right, so quick recap. These are all the things you need to do. I'll provide this deck to Len, and Len can distribute it to all the attendees after the call. So you guys should have said that earlier. Don't feel like you have to take screenshots of this stuff. And this is my contact information at the end of the deck. Okay, that was that one. Do you guys want to maybe in half that time zip through this KPI deck?
Yes, sir.
And then we'll pull up some examples of financial models. So KPIs, key performance indicators. They're metrics to measure and trend and benchmark and set goals for the business. There's all kinds of different KPIs that might be relevant for your business depending on your industry and what the different dynamics are at play. These specifically are dimensional attributes for accounting data, financial data in the business. So data doesn't magically create itself. Business activities can be recorded with a variety of different data points or dimensional attributes. And the more thoughtful you are in designing your accounting and data tracking strategy on the front end, the more insightful your data will be. So I'll give some examples of that in a few minutes. And just like with the financial modeling, the more detail you want to capture, the more resources it'll take to record and analyze that data, and the higher potential you'll have for error with managing a sea of data. But if you don't track enough data, then you lose the ability to derive insights from that data later. So you need to really think down into the future, what data would be relevant tomorrow that I'm working with today, and track that, because it's difficult or sometimes impossible to go back in time and recreate it if you haven't been capturing it. So skipping through here, this one's not very interesting. This one is. So I worked for 2.5 years with Instacart. Instacart's a home grocery delivery service. These numbers are not real numbers. The cities are not real cities, but the example is a real example from my experience working with Instacart, where we were tracking revenue and marketing costs and other one-time setup expenses as Instacart was rolling out from city to city across the country. And they were very interested in understanding how profitable, like which city was generating a positive return and which cities were just a big money pit that they were losing money in. And my firm came up with a methodology for being able to track that data for them and present it in a thoughtful way. And you can see up on the top, if all they were looking at is the total line on the right-hand side here, and they did not have their data split out between these different geographical dimensions, then they'd see they're making $41 million, let's say, in revenue. They're spending this money here, and they've got a $247,000 loss. They wouldn't really understand where that loss is coming from or what to do about it. How do they turn that loss into a gain? Do they just put more fuel on the fire and feel like if they double in size, then maybe they'll get more profitable? But a much more strategic approach is looking at the performance by geographic market in this case. Other businesses might have other ways to slice and dice the data, but in Instacart's example, by geographic market makes a lot of sense. So in this fictitious data set, with Chicago was generating like more than like about a third of almost a third of the total company revenue and over a third of the total company expenses, and it's actually generating a loss while the other locations are generating positive operating income. So by shutting down Chicago and actually reducing the revenue by like more than 25%, they were able to increase the net income at the bottom. So that's an example of how using data, if you're tracking it and analyzing it the right way, can improve the business performance, okay, by a lot. This is a screenshot from a software tool called Domo, D-O-M-O. Domo is a data visualization software platform. There's other ones like Looker, Tableau, Microsoft Power BI. There's at least a dozen or two of those different software tools out there. All of them just take data from the various sources that you have: accounting data, e-commerce platform data, Google Analytics, like marketing data, other things, and brings it into a central warehouse where you can slice and dice it and report on it. So this is another set of data from that on-demand gig economy app business, like Uber for fill in the blank. And it's not Instacart, but it's another business I've worked with in the past. And what this is showing is by geography again, the bookings, like the number of sales that they've made through their platform over time. And this was a California-based business, so it makes sense that they had their first customers in California. Then you can see in, what is this, January 2017, they introduced a second couple of markets. It's hard to tell with the shading here, but this little blue line is either Florida or Connecticut. And then we layer in here Illinois, Georgia, and Texas, and they keep growing here. And by looking at the data stratified by market, they're able to see which markets are performing well and which ones aren't performing well. And if you're correlating that to marketing spend or other activities, then you start to gain some real valuable insights about where to invest your time and resources in the company. And that also tells a great story about where the growth is coming from, so that you can cut the markets that aren't performing well and double down on the ones that are. Okay. I'm going to skip this one. So anyway, those were a couple good examples of KPIs that are useful for a business. So why don't we open it up to just a discussion right now? I can pull up some sample Excel files and we can look at financial model components and answer your specific questions. Hopefully you guys found that useful so far. Okay. So I guess I'll pull up a model if no one has any specific questions.
I have a question.
Yeah, please.
So our model is based on the number of acquired houses, and then there are a couple different factors that we know are going to be in the long run an aspect, but are variable based on area with regards to the how often a house is full with people, and should we factor that as a variable now, or is it necessary, or is it rather better to do it just real time and go based on an assumption that we have a number of houses and take a very conservative approach on their spend, rather than also factor in their occupancy and their spend? It's like so many variables that it could get overly convoluted if we really get too in depth on a kind of a investigative initial investigation by the investor.
Okay, so if you're trying to communicate the ability for your business to generate profits and generate a return for the investor, wouldn't you think the investor would want to understand how you think you're going to achieve that result?
Well, and I'm not saying we're not. I'm just saying it's like, how many variables do you want to showcase before it gets too convoluted and too in depth for like an pre-revenue launch in that sense?
Yeah, it's a great question. So my answer would be test it and iterate. So like right now, how many properties do you have under contract?
We have just over 50. Depends on
Okay.
their availability right now.
All right, and how many would you like to have under contract like 2 years from now?
The goal is to hit 1,000 within
Okay.
2 years.
So it's probably unrealistic, impractical to have 1,000, individual properties listed in your model with discrete assumptions around each property, right? So what I would recommend is you group the properties into buckets that are maybe 2, 3, or 4 buckets where they all behave similarly. They have a similar size, similar price point, similar, utilization rate, things like that. Maybe seasonality is important because some properties are in an area where there's a lot more vacation rentals in the summer and some are in snow country where it's more in the winter. I don't know, right? So,
yeah, and that's exactly what I'm saying. Like, for example, we're starting in the South Bay, but the plan is within LA, we could go into the mountains, and that's more primarily, as you said, a mountain getaway is probably more used in the winter, and so their rate is higher of how many people there versus the summer where it's a lot lower, and vice versa in the beach.
yeah, and as tedious as it is, I think it's important really to model that out discreetly, and to because you can't just apply the same metrics that happen currently in LA to those mountain houses. You're going to be very wrong with your assumptions about the end results if you're not thinking critically about the unique assumptions for those mountain houses.
Yeah.
So you can summarize to be concise and to so that you don't cause brain damage for yourself and for other people, but you need to provide enough detail that you can test the knobs and levers, right? Like, what if and seasonality is important too. So I might be able to find a sanitized example I can pull up that shows seasonality in a financial model. But one way I do it is I have like a January through December set of columns and different percentages throughout the year that I can reference other places. So it might be the utilization rate of the property. And for those mountain houses in the wintertime, it might be 95% booked, right? Or 80, whatever your high percentage is. And then in other months, it might drop down to 50 or even 10% booked, and it's vacant for the rest of the period. And then you can use that percentage to apply to your number of days rented times the daily rental rate times all those other things to calculate your revenues and your costs.
Kind of a direct question here, and not trying to take up all the time, but right now the assumption we created is that what we're basing our financials on is active filled houses, having that many active over a kind of growth, slow growth period of that 1,000 houses. Is that are we missing something in your opinion by just saying, hey, this is a number based on where we would have active number of houses in a growth over time versus, as you say, kind of segmenting out the available and filled versus available and unfilled early on in this pre-revenue, especially with we built this not with more with a general 26 months or 24 months versus like starting in January and ending in January type of concept.
Look, it's okay to have kind of a 30,000 foot simplified view of the business to start with, but I would highly recommend you drill down and get precise with what you have, because you might find a lot of nuances that you weren't considering when you're looking from 30,000 feet down. So for example, what does it take to onboard a new house? You need to do marketing activities that cost you time and money and human resources to engage with the property owners and get them under contract. And how much customer service activity is necessary to manage the bookings that are happening at the house over time. And if the house is booked a lot, then you have more customer service transactions and demand. If the house is booked not a lot, then it's less. And so there's a variable there that's proportional to the bookings and the revenue for you. Once you have these houses under contract, are you spending money to market and attract renters? And how much money are you spending per house? And does it vary by season depending on where the house is? And so don't oversimplify to the extent that you obscure your ability to see clearly to what really moves the needle.
Cool. Thank you.
Yeah. Osi.
Mark.
I'm never going to get your name right.
Detailed questions in the chat. One is, how many years of projections do you recommend to show in an investor deck?
Right. So I'd say at least 18 months, even if you're just a really early stage company, because if some of you I know have experience trying to raise capital from investors, and most often it takes a lot longer than you think it does. It takes more time and more months until you achieve your successful outcome, and investors know that. And so if you're only raising enough money to get you 6 months down the road, then by the time you get your last dollar in the bank account, you're going to be out of money again and have to go back and start raising all over again. You're not going to have time to actually work in the business. So you should raise enough money to last you at least 12 months, if not 18 months or more. And you should have a forecast that shows how you're going to spend that money and what activities you're going to perform and what you're going to accomplish over that time period. And if your business is further along, then you might have a 3-year or even a 5 or 7-year forecast that goes further out into the future. One of my clients is raising somewhere between 60 and $100 million right now, and their forecast goes out 7 years.
Okay, 2 more questions. One, the 3 to 6 categories of use of funds is intended for the initial introduction, though it is still important to have a full breakdown allocation accounted for, correct? Or is it just 3 to 6?
No, the 3 to 6 should be kind of a distillation, a summary of all the detailed monthly forecast work that you've done in your model. So you model things out by month at the lowest level of detail that your brain can handle, that makes sense to break down. And then you can summarize that all up. So if you, back to what we were talking, let me show some examples here. Let's see.
if I can jump in on that too, that's actually Kyle's question, Mark.
Okay.
So I'll let you finish. I apologize for interrupting, but also I think in tangent with that is, you know, if we have the tech team, right, and we're hiring lead engineers, then they fall into the technology, but we're also breaking out, you know, object recognition, machine learning. Or if we're looking at the sales shopper outreach, we're looking at hiring people into the marketing team at different levels, but then also spending on marketing budget. So I think maybe Kyle's looking at, do we drill that down, but obviously having more information as well.
Yeah, fair enough. I have one example, but I have a better one I can pull out in a few minutes. So let's move on to another question. I'll come back to this. What's the next question?
The next question is, can you recommend how to predict salaries over a year or multiple years, especially when people will start at various points throughout the year?
Yeah, so that's an easy one. Let me share my screen here. Okay. So this is an example of a staffing model that shows individual people by role. It shows how much money, is budgeted for each of those roles, and then we got it extrapolated out by month here over time. And we have these broken out into functional areas. So this is the general and administrative team. This is the sales and marketing team, and this is the development and design team for this type of business. And so we can subtotal the salary expense by functional area if we wanted to show how much was spent on design and engineering versus sales and marketing. And that flows through to like an operating expense budget. So this is general administrative salaries and everything related to general administrative. This is sales and marketing. So that's the sales and marketing salaries and everything else related to the sales and marketing function and so on. And that enables the business to summarize the use of funds by just looking at the subtotal of each of these categories over time. So that's one way to do it. And I'll give you another example of headcount, but see, like the way this one is set up, a few things here. One, the business doesn't have 3 CEOs. What this is showing is a step function in how much the CEO is earning. So the CEO is going to start off earning $100,000 equivalent salary, $8,333 a month for 4 months. And then we're going to basically fire the CEO at the end of November, hire them again on December 1st for a higher salary of $180,000. And then step it up again for a higher salary later. Oftentimes you'll do this when the business hits certain milestones. If we get to 100,000 users or $50,000 a month in recurring monthly revenue, then the CEO earns a bonus, or a high, like you can justify a higher spend. Sometimes also when I'm modeling out the staffing forecast, I might say, well, we're going to hire a chief revenue officer not at a certain date, but at a certain relative like performance benchmark, like when we release the software like V2 in the marketplace, which could take 6 months longer than we planned. So as you're adjusting other assumptions in the model, this can be driven by users. I'll have an example to show you that in a few minutes.
Yeah, one of the neat things about this model, as you change that date under employee start date, it actually changes all the numbers in the subsequent columns across.
Right, like if I make this 2-1 or 3-1, you'll see this 15 is going to move over here automatically right when I hit enter. So that happens, but I also have models where I can put the user counts up here that come from a different place. I'll try to find an example of that, but let's say the user count says like 500 here, and this isn't accurate, but just let's say this was referencing like a forecast from another sheet that was estimating the number of users. And right here, I said, hire this person when we get to like 4,500 users, okay? And then this formula can say equals if this is greater than or equal to that, then take my salary divided by 12 and like otherwise it's 0. Okay, fine.
Mark's the master of Excel. That was way above my pay grade right there.
So that says that when we get over 4,500 users, that's when we hire that person. And if I change this to 15,000 users, then we hire them later. So that can be an interesting way to model out a staffing hire. I use that a lot for customer service. If you're going to forecast, once we get to this many customers or users or something else, we need to hire more customer service people. And then if you change other assumptions in your business, like let's say you increase marketing spend to acquire more customers faster, then this number is going to grow a lot faster. And so you'll want to hire this person sooner. And if you use logic like I've done here, it's going to automatically adjust for you. If instead you just put an actual date in this place to hire that person, you'd have to remember when you've changed your sales forecast to go back in and adjust the hiring forecast at the same time. So that's what I meant when I said, think about the relationship, the interdependencies within your business model. If this happens, then that also happens. And as much as you can, try to connect the dots with formulas in your financial forecast model, because then you'll reduce your margin of error and you'll have a better scenario modeling tool. Hopefully that was useful. Lucy, did that answer your question about the staffing, or Kyle?
That was Jason's question, and I think it.
Oh, it was use of funds for Kyle and OC.
Yeah.
Okay, so.
Salary prediction, you answered his question.
Yeah, okay. So going back to use of funds, we've got, like, this is a summary right here. As an example, there's a chart down there, which I need to change the name on. What we're looking at here is we've got staffing model by month for, and this goes all the way out to the end of 2023. And you can see here, these columns summarize by year the 60 columns before it. So this just annualizes those numbers, and that makes it easy to pull those into other sheets and to come up with this annual total right here. So this is the summary level that you would use for your investor presentation. I've got the KPIs here that talk about how many users we expect the business to have, which supports how much revenue the business is forecast to earn. And then the sales and marketing expense includes the staff as well as travel and entertainment and other selling costs. The research and development expense includes the engineering time and development time to build their product. And so if you were talking about use of funds, maybe the forecast, like the capital raise is expected to take you through the end of 2021, then you have your answers right here. Okay. And you can zero out the revenue and see how much money you spend net of revenue to get that answer more clearly if you need to. What else do we have in terms of questions?
Thanks, Mark. Appreciate it.
Yeah,
Those are all
no
the
problem.
questions that were in chat, Mark.
Okay. Any other questions, or you guys want to kind of go off script and I can show you some more? Oh, I have a good one. User cohorts. We have a few people that have user-based businesses, and then I know we've got like product-based e-commerce type businesses as well, e-commerce and wholesale. So I can try to pull up some examples and we'll drill into those if you'd like.
How long do you want to go for, Mark?
It's up to you. I don't want to just kill time, but if people are getting stuff out of this, we might as well.
So let's target 1:15.
Okay, great. So let's see.
Does anybody have any questions? If you do, please feel free to either shout out, you can unmute yourself, or go and chat.
I'm going to show you while we're waiting for questions the user cohort. So this is several different ways that I use to model out revenue. This is an enterprise software business. So this is one way to show potential customers, enterprise customers, when those enterprise contracts would likely start. This is kind of like a sales pipeline. If you actually have specific customers you're targeting or customers of a certain size, and you can use this to model out a pilot phase of revenue and then a fully installed phase of revenue. If you had, like, you know, a smaller price for the initial 3-month or 4-month pilot, and then it steps into a larger price when it's a full-scale implementation. And then you can total this up at the bottom and you'll get your enterprise revenues, and you can also count how many users you would have over time and use that to model out other aspects of the business. This is a different way to model this out. This might work for your vacation rental business, where you can have a few different categories of vacation rentals that behave differently and different assumptions for each one. And then you can kind of extrapolate out over time how that all works out and what the end results are. For
Mark?
Yeah.
Brian Fife here again.
Hey, Brian.
I'm right now I'm facing, because we're seeking to hire our first kind of round of part-time Alfreds, and I'm gonna, you know, kind of getting prepared for adding their time management into the marketing aspects of how we quantify, you know, how much we've spent on, you know, marketing, customer service, because really what our Alfreds are is kind of a hybrid. They're both customer service as well as an upsell, marketing, sales type of role. Hold on. Sorry about that. Is there a way in which you integrate payroll to factor, you know, each role's kind of factor within, like, for example, if part-time member A is working on houses, you know, A through B through a period of a week, I want to be able to quantify how much I actually spent per house on employees. Is there a recommended, like, kind of existing integration with your payroll? We're looking at right now Paylocity, but I kind of, you know, there's so many variables that I'm unaware of, and this is my side of the coin, is more on the operations, but not necessarily on the financial operations.
Yeah, I like Paylocity. It's kind of a complex payroll platform, though, for an early stage startup. So
Okay.
We can talk more offline about whether there might be a more streamlined platform for you to use, but I wouldn't be too concerned about integrating your financial forecast model with your payroll platform. So
Okay.
maybe I don't understand your question.
Well, what I'm saying is that with regards to my current forecasting, and then obviously in getting into live mode, I really want to be able to quantify how much each rep costs me associated to their calls. And my hope is to have, you know, a clear-cut time tracking aspect that says that they're working on, you know, which house that they're, you know, if I spend 15 minutes on a house, I know that, you know, was $3 of a $15 an hour employee. And if that house generated in that call, you know, say $30, then my, the profit on that for just related, obviously not factoring in every other variable that's involved in it. But if I was just to say the cost of humans minus the profit on that, it's pretty easy. But, obviously getting into more and more in-depth Excel spreadsheet work, which you are obviously a master of, is there something I can be factoring to help me with my payroll system already kind of playing that role?
Yeah, no, the payroll software like Gusto or Paylocity isn't going to be a good tool for forecasting your payroll demands over time.
Mm-hmm.
You really need a tool like this.
Mm-hmm.
So I'm glad you brought that example up, because if you've got somebody who you expect to spend 15 minutes per house times X number of houses in the future, and that's going to arrive at how many minutes they spend working, and you calculate an hourly rate times those hours to get the cost, make sure you're also budgeting for like non-productive time.
Mm-hmm.
Usually people can only work between 80 and 90% capacity.
Yeah.
At optimum efficiency. You need to budget some time for non-productive work that you're still going to pay those staff for. You should also consider raises. People need to earn more money over time, so make sure you're factoring that in.
Okay.
You've also got payroll taxes and overhead.
Sure.
So, and you might have recruiting costs, whether you're paying a recruiting fee or you're spending money on job postings online or doing other things to attract people to your business.
Okay.
You've got payroll taxes and overhead as well. So workers' compensation generally is from like less than 1% to up to like 1 or 2%, depending on how dangerous your business is deemed to be by those insurance companies. You might be paying for medical benefits or other benefits. Payroll taxes are going to cost between 8 and 10%, depending on how quickly you have turnover on your staff and how much you're paying your staff. So this model right here considers all of those different things for these people. And I also like to think about travel and entertainment budgets for each individual person discreetly, because like salespeople are probably going to be incurring some travel and entertainment costs, but customer service people are not, and engineers are not likely going to be incurring much, depending on your business model. So if I change when I hire my salespeople and I need to hire salespeople faster, then that's going to change what I need to budget for travel and entertainment costs faster as well, or slower. So I like having those all tied together, and then I have some fancy formulas down on the bottom that that subtotal the travel budget and the meal and entertainment budget for each person based off of when those people come onto payroll. So you can see that those costs go up over time as we add staff. Hopefully that's helpful as an example.
Yes, thank you.
Sure.
Can I jump in with a question?
Yeah.
So two questions. One is, when you're going through diligence and you have a data room with investors, all this amazing information we've built with projections, assumptions, staffing, revenue growth, what are the 3 best visuals to make sure that we have additionally in the data room with everything that we've built out? Is there just 3 really good visuals that we can extract this information of? That's my first question.
There's not a one-size-fits-all answer. Really think about, what do you want investors to focus their attention on and to get excited about? You're not trying to answer everything under the sun in your first pitch, in your first conversation. You're trying to captivate their interest and make them feel like they're missing out if they don't spend more time talking to you further. So the answer is different for each business. For you, it might be empirical data about your active engagement with actual paying customers today. And that's where the focus is, because your business lives or dies based off how well you onboard new accounts and how sticky they are, right? For other businesses, it might be how competitively differentiated their technology is and the intellectual property that they have around that technology. You know, the answer is very different for different businesses.
Great, thank you.
Sure.
The other question I had was, when it comes to staffing and growth of that, is it okay to just apply kind of a general, call it 5 to 10% a year growth for raises for the entire team, rather than going in item by item and breaking it all down?
It is okay to generalize if that is going to be intuitive and sit well with the investor. But if you're planning to have a business where most of the staff are kind of like low-paid, blue-collar type gig workers, then the compensation dynamics might be a lot different than if you're going to employ a bunch of software engineers and data scientists. So make sure it resonates with empirical data. I know we're running up to the time limit Len set for us. I just wanted to show you guys, this is an example of that cohort analysis, the cohort forecast that I put together for a user-based business. And this considers customers that come on board the platform in any given period of time. And then so that's, in this example, 250 new customers started in October 2020 in this model. And then 2% of them churned out, you know, in the next period. So if I change this to 10, then you can see this drop to 225. If I change this to 50, then we lose half the customers. So of those 250, only 125 stuck around in the next month. And then 20% of those dropped off in the next month. And then 15% of those dropped off. And that gives you a really clear way to model out the user behavior and engagement over time. And you can start adding those up down at the bottom to get your active individual users, but it gives you the ability to model out churn a lot more precisely because you're thinking about the churn relative to when a user starts on the platform. And the last thing I'll do with regard to user-based businesses, because those are fairly popular here, are organic referrals. So it's likely that users are going to refer more people in their first month of usage, and the more seasoned they are, the less likely they're going to refer. So when you're thinking about the organic referral engine, I caution against just saying, well, we're going to grow by 1% of our user base organically each month into the future, because that 1% is not likely going to stay constant over time. So look for some research online, see if you can find other organic referral rates that are published to support your assumptions. Okay, so I'll send you the 2 pitch decks that I've shared already. And if folks have questions, of course, I'm happy to field them over email and get on a phone call.
Super. Mark, thank you so much. I want to thank everybody for being on the call. Nice to meet new people at our workshop. Our next workshop is scheduled for December 8th, and it's going to be on pitch deck presentations, how to build your pitch deck and how to utilize it.
All right.
Thank you, Mark. I'm SpongeBobbing over here, taking it all in. You're the best.
Thanks, Mark.
Thanks, Lonnie.
Yeah, thank you so much, Mark.
Thank you, Len.
Thank you, Mark. Thank you, Len.
Thanks, Len.
Thanks, everybody.
Bye.
Bye-bye.